Hey everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. With today's video, I'm going to cover 10 small to mid-cap growth stocks that I would call GARP growth stocks, which stands for growth at a reasonable price. And I was kind of inspired to do that because I got a question on my last comment from Alex C., who said, if you had to start your investment portfolio all over again today with the goal of having an option to retire in 10 to 15 years, how would you theoretically build it? Now, that led me to thinking about a lot of things. Number one is I also have had questions and comments recently on a couple of videos I did, I think a couple of videos back, wanting to see my portfolio. And I will never show my subscribers my individual portfolio, but I don't do it because I'm this privacy freak. I do it because I believe it could be very, very damaging to people to review my portfolio for this simple reason. I don't have the same goals and objectives. I don't have the same financial situation. I don't have the same risk tolerances as everyone who would look at my portfolio. And as a portfolio manager, I'm a fervent believer in custom designing the portfolio to meet all of my unique clients' specific goals, needs, objectives, and risk tolerances. I just think that's common sense to me. And, you know, when people also want to go onto my EDMP site, which is Earnings Determined Market Price, is what that acronym stands for, which also relates to FastGraphs, which I'll get into here, circle back to in a moment here. But the point is this, a lot of the stocks that I hold may not be stocks that I would be willing to buy today, okay, because I make a distinction between the buy decision, the sell decision, and the hold decision. All buy decisions have to be made under the, strictest principle you can of valuation. I'm looking for fairly valued stocks at the worst, and I'm looking for undervalued stocks to give me a margin of safety at best. So that's also important. But then I also had another comment on my last video, yesterday's video, that from Chuck Diesel. And Chuck said, Chuck, great video. Do you have a video or article explaining how you came up with and developed the original FastGraphs tool? Well, it is kind of an interesting tool, and it does relate dramatically, I think, or it relates quite well to this particular theme of this particular video, because it all started with my economics professor in college back in 1970. And he had had a study that was conducted by Pershing. And it was a study that went back about 50 years, if I recall, maybe even longer. And it was where Pershing had drawn a graph, and they compared the earnings of the S&P 500 to the stock price of the market over this 4, 5, or 6 decade time frame. And my professor would show us this document in class, my economics professor, and he would pound the desk, literally take his fist and pound the desk. And he would say, earnings determine market price. And if you're going to be an investor, you've got to focus on earnings. And then, of course, I later developed EDMP, my money management firm, in his honor, if you will, and I named it Earnings Determined Market Price, or EDMP. And there's a twin sister to that, by the way. There's an emotional twin, EDMP, which stands for Emotions Determined Market Price. And that's the short run that creates a lot of volatility and why markets can become overvalued and undervalued. But then there's the true EDMP, which is the long term. And that relates to Ben Graham's famous metaphor that I quote so many times. In the short run, the market's a voting machine. That's the emotional side. People vote their shares and the price jumps up and down. But in the long run, it's a weighing machine. In the long run, it's the earnings of the company. So the long run EDMP is earnings determined market price. In the short run, emotions can have a big factor. All right. But then, this got me thinking about other things as well. How would you design a portfolio for a person who was looking to accumulate as much wealth as they can? Now, by the way, that's not just financial statement oriented. That's not always just age oriented. Okay, it could be the financial status. If you have, a well-built portfolio and is generating enough income for you to live off, and you have excess capital, you might want to invest some money into growth stocks, for example, if you have that luxury. Other retired people, for example, might not be able to take the risk of speculating in growth stocks. But anyway, what I'm trying to get around to is if I was to, when I originally started investing, maybe it's a better way of saying it, and I've got a young son now who works here with us at FastGraphs and EDMP, and he's investing like I did when I was his age, and he's looking for growth. He's looking to try to make as much money as he possibly can, and he's not that risk averse because he understands that he has time, and time is so critical in this investment process. So I'm going to be talking about growth stocks, and one of the advantages of growth stocks is that they compress time. all right, because they grow so much faster. And I use different criteria for evaluating growth stocks than I do what I call the average. The average stock is about a 6 or 8% grower historically. True growth stocks, by my definition at least, are companies that grow at 15% a year or better, or are capable of growing at 15% a year or better. In other words, they are compounding monsters. And I'll get into that in a little bit. So let me try to kind of relate to this by sharing a slide presentation with you that I call the power of compounding. You know, it was alleged that Albert Einstein once said that compound interest was the most powerful force in the universe. Now, whether Albert said that or not is debatable, but the point is that compounding is a very powerful force, especially when it comes to finance and investing. So let me kind of go through this for you if I can. And it all starts with understanding how compounding works. And that, you know, the best way to do that, in my experience, has been to, look at the rule of 72 and run it through a little exercise for you. The rule of 72 states if you divide any rate of return into the number 72, it tells you how many years it takes to double your money or to double the number. Okay, so that's very critical. How fast is your money doubling at different rates of return? So, my economics professor, the same gentleman that showed me the Pershing graph, he actually created this presentation. And he said if you invested $20 a month, which was $240 a year. He used to like to ask us this and do it actually on the back of a napkin. And he said, I'm going to just call 36 years a hypothetical working life. Now, the reason for that is because, as you'll see here in a moment, it makes the math work real well. He said, if you earn 10% a year, he said, I'll give you the answer to this part, you would accumulate about $80,000. Then he would ask the class, or other people for that matter, because I saw him do this presentation for people. He would say, how much would you have if you doubled your return to 20% a year? Now, the knee-jerk reaction to most people, and of course I'm certain that my subscribers here to this YouTube channel are much more sophisticated than that, but the average unsophisticated investor would immediately say $160,000. In other words, if you're if 10% gave you 80, then 20 would give you double that, or 160. But that's not how compounding works. Okay, the real answer was at 20%, you'd have over $1,500,000 or 19 times more money. Now, this was investing a stream of income, $20 a month, which he used to say back in those days was cigarette money. What people were spending a month on cigarettes, if they would just invest it, if they earn 10% a year on their money, they could earn 80. Now, keep in mind, earning these neat rates of return consistently every year are impossible. The point here is to understand the mathematical realities of how this whole thing called compounding works. And the reality is that it compresses time. So let's go back to that 36 years of working life again. And if we earn 10% of our money, that means we would double every 7.2 years. So if you double every 7.2 years and divide that into 36, you would end up getting 5 doubles in your lifetime. If you doubled the rate of return or cut in half the time it takes to double money in 36 years, now if you divide 3.6 years, which is how fast that money doubles at 20%, into 36 years, you get 10 doubles. So the math, the compounding, if you will, looks like this. If you just study your first dollar that you invested, if that dollar earned 10% over 36 years and it doubles every 7.2 years, you get 5 doubles. So $1 would double to $2, $4, $8, $16, $32. There's your 5 doubles. But if you doubled the rate of return and cut in half the time it took to double, instead of getting 5 doubles, you would get 10 doubles. So now you go 2, 4, 8, 16, 32, 64, 128, 256, 512. That $1 grows to $1,024 or 32 times more money on that first dollar at 20% than if you'd earned only 10%. So the moral of the story is compressing time doubles the doubles, not doubles your money. And that's why earning higher rates of return can be so beneficial or so helpful. Now, the way you do that is you have to invest in growth stocks. And I define those, as I said a minute ago, as companies that are growing at least 15% or better. And there's a lot of rationale behind that. So let's go ahead and look at a compounding table just to kind of solidify all this and clarify it. If I look at a compounding table, I'm just going to do a 10-year time frame here at 5%, which is real close to the average return of stocks. The average return of stocks has been between 5 and 10% a year, 7, 8%, some people say, etc. But the point is, if you're earning 5% on your money, okay, $1 invested would grow to $1.62 after 10 years. Okay, at 15%, it would grow to $4.05, which is obviously significantly more. At that 20% number I talked about, it would grow to $6, and at 30%, it would go to $13.79. So the point is, you can see the crossover here. Once you start getting into these higher rates of return and you start compressing time a lot more dynamically, that's where the magic happens with investing. So if you're just starting out and you're trying to accumulate money and you're willing to take the risk associated with growth stocks, because to earn these higher rates of return, you do have to be willing to take on higher rates of risk, because the world won't let investors earn this kind of money too long before competition starts coming in. However, with that said, there are companies that are growth stocks. So what I did for the younger people, or for the more aggressive people, or the people that have excess capital and are willing to take on some excessive risk, I put together 10 what I call GARP, or growth at a reasonable price, stocks. These are mostly small and mid-cap companies. Now, the logic behind investing for growth in small and mid-cap companies comes to do with the law of large numbers. Okay, you can see these companies range in market value from $1.6 billion with Malibu Boats all the way up to $29 billion with Skyworks, which is getting into the mid-cap range, but it's still a smaller company relative to the Microsofts and the Apples and the Googles and so on of the world, even the Johnson & Johnsons and some of the big pharma. These are smaller companies, okay? And this group of 10 companies I've put together here, they have different estimated growth rates. My criteria was they had to have forecast growth of at least 15% a year. Now, my logic is, I can learn from the past, as I always say, but I can only invest in the future. Now, this is based on estimates, and it's a forecast, and it's not necessarily etched in stone, where historical data is real. This is forecast. It's an estimate, okay? But I looked for companies that had good historical track records, and I'll show you that here in a moment, but also were expected to grow at 15% or better, and it ranges with Jazz Pharmaceuticals at 15.27%, all the way up to the home builder NVR at 21.77%, okay? So these are all companies that can get you into that 15 to 20% plus growth rate that I talked about. So let's go ahead and look through those. Now, I'm going to go through these in a kind of a random order here, because there's some very interesting things here. I mentioned my young son earlier, and my young son invested in this particular company at around $110 a share. That's about as close as I can get right there. There's 113. And this was about right. It was in late 2018. And, I had obviously given him the Rule of 72 lesson. It's the first thing I make anyone that comes to work with my firm do. They got to go through compounding and do it by hand. By the way, I have them actually go through and take $1 and grow it by 5% over, a year, over 36 years. And I grow it by 10% and 20% and so on. And, and I also say earnings determine market price, and that I don't focus on the stock price. I focus on the earnings, and I trust the earnings more than I do the stock price. That's another one of my mantras. Those of you who've been, subscribers to my YouTube channel have heard me say that so many times, I'm sure. But he bought the stock when it was what we considered a significant discount to its intrinsic value. Now, the company did pay a dividend for a couple of years here, and it was struggling with some assets growth here for a little while, because this is an asset management. It's a money management firm. What this company does is they actually acquire smaller and mid-sized money management firms, and then they give them back office and give them a lot of support and allow the money managers, though, to make their own decisions. And if I go here to the external links and go into the company's website, there are some, really very strong boutique firms, that the company actually works with. And some of these are, some of the best, I believe, in the country. They've got global international equities and emerging market equities and U.S. equities making up half of their money. They got alternative investments, liquid and liquid alternatives, managers that run those. And then they got multi-asset and other class represents about 8%. But let me see if I can find you some of their affiliates here. You might recognize some of their names. The Ochman Funds, Artemis is a well-respected and known one. So anyway, this company, has some really good firms in here. Pantheon's well-known and well-respected. So Veritas Asset Management. Ochman, I already mentioned. So this company has a lot of these boutique managers. But here's the reason I wanted to show you this one. Now, by the way, it is forecast to grow. It is forecast to grow at over 19% going forward for at least the next couple of years. The longer-term growth rate is expected to be right at my 15% threshold. Remember, I only wanted companies that could grow at 15% a year or better. But the reason I wanted to show you this was, my son bought this. There's 110. That's right at what he paid for it. And then immediately proceeded to see this stock, fall down, be cut in half. He lost almost, half his money in the stock had he sold it. This is an unrealized loss. I kept telling him, trust the fundamentals. The company's shown a little weakness now, but forecasts were for it to do really well, and I'll get into that in a moment. And so he held on, and we went through COVID, and of course that even exasperated the matter worse. You can see the big drop that happened with COVID, even though the company was already very inexpensive. But then now we've been on this rapid ascent. Now, if you look at what he's done since he's owned this stock, and again, I'm going to get this, reasonably close. He's averaging about 20% a year now in just a little over a couple of years. That's his annualized rate of return. He's up about 48% in total if you looked at it. And the point is, the company is still very inexpensive in my point of view. Now, if I look at this stock, over the last several years, you can see that the price has tracked earnings very beautifully here. And the market does like to get overvalued at times. And there are times when it undervalues it. And as I pointed out in yesterday's video, buying a stock when it's undervalued is always a good option. Now, my son actually added money to this because, fortunately for maybe once, though he's actually a good kid, he listened to Dad and he trusted the fact that in the long run, earnings determine market price. In the short run, it's only emotions that he was dealing with. So if I look at Affiliated Managers Group, this company has tremendous potential, and I would value this at a PE ratio equal to its growth rate because that's how I value faster growing stocks. But even at a normal 15 PE ratio, if you will, which is this line down here you have an opportunity to make these incredible 35 plus annualized rates of return over the next couple of years from where we sit. And remember, he's already made 48%, even though it's been a roller coaster ride for him, thus far, obviously. But anyway, here's Affiliated Managers Group. And by the way, this company has outperformed the market historically through its history, but only by a modest margin. But the key is we think the best is yet to come. The long-term growth rate for this company is expected to be 15%. And because there is a margin of safety here, that could translate into 20% plus rates of return like I talked about, in my opening here to this video. The next one I want to talk about, these are in no special order, is Focus, which is another asset management and custodial firm that has a very similar situation. What they do is let small portfolio managers, they, again, do very similar to what Affiliated Managers Group does. They've had nice growth as a public company, averaging over 23% a year. They're forecast to grow at about over 15.6% for the next couple of years. And their long-term growth rate is expected to be over 16% of growth. So here I would be using a PE of 16. And when I'm using this one, I'm using a PE of 15. Regardless, I'm getting, the potential to make 15 to 20% rates of return, regardless of which way I look at this, assuming these numbers do actually come to pass. And that's always the assumption, but there is greater risk. And do notice that there's volatility with these growth stocks. The next one we're going to look at is Skyworks here, and I want to shorten this time frame a little bit. This is a semiconductor company, and it's one that, for disclosure, I'm actually long on. All right, historically, it's grown at over 20% since coming out of the Great Recession. Its performance has, trounced the stock market, the S&P 500, over 27% versus 11 or 12 during that period of time. It's forecast to continue growing at just under 18% a year. So now I'm using a PE line for those of you who are asking of 17.89. I want you to notice that. And, on that basis, that's the red dot, red in the pop-up there, a PE of 17.89, not the normal 15 that I use. I also want to talk about things like earnings yield. I will take a lower earnings yield because forward earnings yield is what really becomes important when you're dealing with these companies, these growth stocks. And this company is expected to grow at 23% a year. It's followed by quite a few analysts, by the way. There are 25 or 30 analysts that follow it, and they give this long-term growth rate potential here, which means this could be a terrific long-term holding for those, and you could buy it at a reasonable price. Now, the market has typically price this thing at about a 15 PE. I would be remiss if I didn't point that out. So even if you're down here at a 15 or 16 PE, you could still make money. But on the long-term growth rate, if this thing gets down to a 15 or 16 PE, I could still make, 10, 12, 13, 14, 15% a year. And of course, if I get a chance to buy it a little cheaper, that would even be better. But the point is, this is another one of the growth stocks. And this company is one of the largest I'm showing you today at $29 billion market cap. The next one I want to look at is the home builder NVR, and I'm going to look at coming out of the home building industry. Earnings growth has been 23.7% a year, doesn't pay a dividend. Its historical performance has been 21% over 14 for the market over the same time frame here. So it's been a really great performer. I do actually consider the stock undervalued based on their historical growth and fairly valued based on their future growth. But this is, again, another opportunity to get double-digit rates of return. And keep in mind, that's based on the stock trading at this 16 or 17 multiple. If I look at the company, historically, there were plenty of times where it traded at 19 and 20 times earnings, even 25 times earnings. That can happen when you buy these growth stocks, but then you also have the risk of seeing these big drawdowns that can happen occasionally if there's any disappointment. And notice this drawdown occurred right here. That's something you should always be aware of. This was a 40% drawdown during a time when the earnings were just killing it. 37% and 38%, but there was expectation of a slowdown, and there was a slowdown in earnings. This is obviously one of the better home builders in the country, and it's an $18 billion market cap. The next one I want to show you is another one that I'm long on in certain accounts, United Rental. It's grown at over 17% a year, a classic picture of how when you get a chance to buy these kind of stocks, when you get them with a great margin of safety, what a great way to get what I call natural leverage, to be able to leverage your portfolio and invest in these things when they're cheap. Now, it's not dirt cheap now. It's actually slightly overpriced. It is expected to grow at 15% a year for the next couple of years. The long-term growth rate is a little more kind at around 19 or 20% a year. So you could still buy this stock today, but I would watch to try to get this company when you could buy it at a discount. But, I did buy it down in here. And, and by the way, this one, the reason why this stock is getting hot is because it's considered, it's a trading company and distributor, and it's considered a play on the infrastructure build out that's going on in the country, because you can see some of the products and things they make, boom lifts, scissor lifts, workhorses, etc. They make aerial platforms, earth moving equipment as well, aerial work platforms that I just was showing you, forklifts, so it's all, it's a company that's going to be helpful in the construction of the infrastructure we're talking about. The next one is Chemours. This was actually, it's a chemistry company called Diversified Chemicals. Somewhat cyclical. This was a spin-off from Dow Chemical originally. That's why it doesn't have much of a history here. Its performance, since right after it was spun off, has been really good. It's averaged over 40% compared to 16% in the market. Remember, the market had great performance there. It's forecast to grow at over 18% a year, which is, pretty exciting for the next couple of years. Long-term growth rate is expected to be as high as 30% a year over a time frame. Now, the bottom line is these are companies, these are riskier stocks than what I normally cover for. I want to reemphasize that again, but you can buy these stocks at really attractive valuations and prices right now. This stock is inexpensive, but the market never values it very high. You should also take that into consideration when you're looking at it, okay? The next one is Borg Warner, pretty well known. It doesn't have a great historical growth rate, but it is expected to grow at 16% or better. And I use this one to make that point. I can learn from the past, but I can only invest in the future. Now, the reality of it is analysts have been increasing their estimates on this company. It's a great company. Once again, if I go into the company's website, it's a company whose products most people are actually familiar with, even though they might not know the BorgWarner name, off the top of their head. And I always recommend going in and learning about these companies. The long-term growth is expected to be almost 25% a year. So, this all has to do with what's going on in automobiles and technology and so on right now. So you might want to take a closer look at BorgWarner. Next one I want to show you is Wesco International, which is another trading company. This one's, very, very interesting. If I look at it, it's moderately cyclical. But just look at these relations between price and earnings, just how phenomenal that is. Earnings determine market price, EDMP, as I said earlier, in the long run. Emotions determine market price in the short run. This is a quintessential picture of that happening. But the company's had good growth. Its long-term performance has been, consistent with, what its earnings growth has been. It's outperformed the market over this time frame, and it's forecast to grow at about 17% a year going forward over the next couple of years, and longer term over about 20 times earnings. So Wesco is a very interesting one to be looking at. And then finally, last one I'm going to show you here, actually, let me correct that. No, I've got one more after this. I'll take that back. Is Malibu Boats. I've written about this one before. This company's grown at about 27% a year historically. Market likes to value it at that 15 PE, though I do want you to notice that. The company's forecast to grow at about 19% a year, but even if you price it at the 15 PE, it would still produce double-digit rates of return going forward. Long-term growth is expected to be about 17%. Company's, historical performance has been exceptional compared to the market. And for those of you who aren't familiar with it, they build and sell very popular class of boats. The Malibu boats are very popular, and people are looking for relief and, trying to have some fun and enjoyment with all that's been going on in the world here in the last couple of years. So Malibu Boats looks very, very attractive to us here. And then last but not least is Jazz Pharmaceutical. And this has been in the news a little bit lately. I'll let you guys check this out because I want to make a comment about that here in a moment. But if you look at Jazz as a long-term grower, it's been, growing at over 20% a year. If you look at its performance, it's averaged that 20% rate of return to its shareholders. It's forecast to continue growing at about 15% a year, and long-term growth is expected to be over 15% a year. And I always recommend go into the company's website when you're looking at these. These are all companies that I'm presenting here for you to research. I don't know a whole lot about these companies. I don't invest in these kind of companies anymore. I do know some of them. I have bought them for some of the portfolios we're looking for total return, like United Rentals. I mentioned Skyworks, I mentioned, but most of these companies are companies that I have screened for that appear to be able to grow at 15% a year or better over the near-term future. And then, of course, they also require continuous monitoring. So this is for some of you who've been asking me about what would I do if I was younger, or what would I do if I wanted more, growth than I did, dividend income. And so for those of you who follow my channel, I thought it'd be fun to give you some growth at a reasonable price solutions here. Hope you enjoyed this video. If you did, give me a like, ring the bell. Subscribe to the channel if you haven't already. And also, you might want to take a look at fast graphs. I've obviously utilized a new version here for this particular video. We're getting real close, guys, for all of you who keep asking, and I really appreciate your patience so much. It's going to be awesome when we get it done. As you can see, we can go through stocks here very, very quickly with the new version compared to the current version, and it's something we're real excited about. Thanks for watching. I'll talk to you guys again real soon.